Ladies and gentlemen, it is March 23rd, 2021, and this is a live stream. I had a request from 2GunzBoxing. He said, do a video about algorithms. Do a video about TWAP, VWAP. He said a lot more other things too. I'm not going to share with you because this is a family-friendly channel. But here we are doing a live stream, fulfilling the request of 2GunzBoxing. What is an algorithm? What is a trading algorithm? We're also going to touch on a little bit VWAPs and TWAPs. But as you know, before we get started, we got a jam. That's entirely enough of that. We got better things to do. This is, by the way, Carlisle. And we're talking about algorithms. So what's an algorithm? So in trading, an algorithm is sort of like, well, in programming rather, an algorithm is sort of like a recipe. So how do you bake a cake, right? Cake, finished product, right? How do you actually create a cake? You essentially follow an algorithm, right? You look at these ingredients and there's steps that you take. And if you follow these steps, the outcome is the final product, which is the cake, hopefully, right? So in programming, we use algorithms in a similar way to build things. Now, in trading, it's kind of a similar thing. And I guess what the product would be is you want to get, well, you want to target ideally a specific, I don't want to just say best price necessarily, because sometimes that's not necessarily your focus. I mean, you'd always want to get the best price, but that may not be your priority. That may not be the reason why you're using the algorithm. But you want to achieve a certain trading goal or trading outcome. Now, the two particular algorithms or benchmarks that algorithms use are VWAP and TWAP, and those have two different goals. But in general, a trading algorithm is a mechanism that allows for automated trading. Instead of you sitting there and you're watching charts and making decisions, buy here, sell here, buy there, buy, sell, sell, sell. You pretty much have a position that you want to acquire, and you pass an order to an algorithm, which is run by computers, of course. And that algorithm is going to say, okay, you want 1 million shares of IBM. Okay, and this is how you want it. Tell me how you want it. Tell me how you want it, and I'm going to deliver, right? So based on the parameters that you set, it's going to deliver those 1 million shares in a certain way. We're going to get into more details about what that means exactly, but essentially that's what it is, automated trading. Certain amount of shares you want to buy or sell. You put it in the system, enter it, and then it's going to be broken up into child orders. So if it's 1 million shares total that you're trying to buy or sell, it's going to break it up into little pieces, 1,000 shares, 100 shares, whatever it is, and it's going to trade it out throughout the day, depending on what you're trying to achieve, which again, is not always trying to get the best price. And we're going to get into that. So that's essentially what a trading algorithm is. It's a mechanism that allows for automated trading to achieve certain specific results that the trader is looking to achieve. And again, we're going to get into that. Stay with us. We're going to get into more details about that. With options, your entire strategy is based on what you think. I'm going to give you the fixed protocol. Options Greeks. And we're back. So we covered what a trading algorithm is, and we covered essentially why you want to use a trading algorithm. You want to automate trading, and you want to achieve certain goals. Now, let's cover how the algorithms can work. Now, there's software that actually allows you to create custom algorithms. So they can kind of work however you want them to work in that scenario, because you can set parameters. Let me give you an example of a basic algorithm that you could set. I could create an algorithm if I have software that allows me to create custom algorithms, and usually, well, there'll be different levels. There'll be probably a level, depending on what software you're using, where you can create really, really advanced algorithms using all kind of mathematic mumbo jumbo, or super, super basic. For example, I'll just make one up on the fly. Okay, I'm a meme stock trader, and I think GameStop is going to the moon, Alice, sometime today. I don't know when. I don't know why. I don't really care. I just want to ride to the moon, right? So you could create a GameStop algorithm. What you want to program it to do is to basically look for that surge, right? You don't care about the little ups and downs. You're looking for the launch, launching to the moon, right? So you need to somehow define that. So let's say you define it by price delta versus time, right? Meaning change in price over time, right? So you've determined this is what a moon launch looks like. The smoke, the sound, the thunder. You've determined that GameStop is trading at $200 per share, and you think when it starts launching, it's going to go up by $5 in a period of 3 minutes, right? That's based on what you've seen in the past. If it goes up more than $5 in 3 minutes, then it's probably launching and you want in, right? So you can create an algorithm that basically has the capacity to look at price changes over time, and whenever your conditions are met, that's the parameters you set. You set $5 as the price change, you set 2 minutes as the time, right? Once those parameters are met, at any point in time during the day, it sees price move by $5 within 2 minutes. Trigger, launch, right? So basically you put the total amount, like you're looking to, you want to have a big position, you want to make a lot of money, you're trying to be rich, you're trying to buy a Lamborghini. So you want to buy 1,000 shares, 1,000 shares of GameStop. So the algorithm sits there watching all the prices, market data is coming in, all those price changes, moving up, moving down, moving up, moving down. At some point in time, it keeps checking, like my volatility tracker app that I created. Basically, what I'm doing is I'm looking at the prices and I'm looking at how much it changes over time. Now, it's not an algorithm, that's an alert tool, but still same kind of mechanism. At any time that math is satisfied, the price change within a time frame is more than $5, that's going to activate the algorithm to start trading. So you want a total of 1,000 shares. It's going to start aggressively depending on your parameters, right? You probably don't want to put out everything at once, but it can probably be set to start trading at that point in time, but not everything all at once. So if you're trying to get 1,000 shares, as soon as you hit that threshold, it may just start going live. So it's like 100 shares GameStop, 100 shares GameStop, 200 shares GameStop, 300 shares GameStop, and it just keeps increasing as the price goes above, or the price surge keeps growing. Then it keeps entering larger and larger orders, and you can also protect yourself by creating a sort of a reverse of that in the algorithm, which looks for the reverse effect. So if it looks like a false launch, so you see it moving up $5 in 3 minutes, and all of a sudden it's like it's flattening out and starting to go down, you can also set the algorithm to do the reverse, which is like, oh, this is actually an abort, it's crashing. So it can actually reverse out your position, hopefully before you take any losses. But I wanted to get you to understand just that basic concept, that there's an idea of an algorithm that we can create. Obviously a key function or key thing that an algorithm is going to need most likely is obviously going to be market data. You need to know what the market is doing, and then you're going to need some kind of parameters that the user can set in terms of maybe start time, end time. Aggression levels is something that you'll find that's typical. How aggressively do you want for it to function? Like, for example, in my example of the GameStop algorithm, you could be really, really reckless and just say super aggressive. So as soon as launch is detected, it's like 500 shares GameStop, and then a few seconds later another 500 shares of GameStop, and then it's a false alarm and it just crashes and you're screwed. right? Or you could be a little bit more passive, and you could, don't make your limit prices as aggressive. Anyway, so that's an idea of how a basic algorithm could work. Now, let's talk about two benchmarks. Not necessarily algorithms, but two benchmarks that an algorithm may use. Because one of the key things about an algorithm is you want to be able to judge the performance of the algorithm, right? How good is the algorithm performing? Just like you would with computer hardware, you have benchmarks. You have the 3D benchmarks where, you build a computer and you do your own custom thing. I'm going to get the latest processor and this and that, and I'm going to do a little different. I'm going to do this new hard drive, whatever it is. You have a special setup. It's unique to you. You built it yourself. How good is this system? It looks impressive to you, but you want a baseline to compare it to in terms of how does this system compare to other similar systems. So you have these standardized benchmarks that other people can run, and then you can compare their results to your results and get a sense of how good your computer is. So with an algorithm, you want a way to basically assess the performance of the algorithm. And to do this, generally the thing that we do to do that, it's called TCA, or transaction cost analysis. So we can run reports on the algorithm to see how well it's actually doing. Now, one of the things that the TCA report, transaction cost analysis report, will look at is compared to benchmarks. So you have something like the volume weighted average price. So you have an average price over the day, right? Average means average, right? So you're looking at, it traded at this price, traded at that price, traded at this price. Okay, let's look at the total amount of executions, right? And let's look at what the prices were, and let's do the math to get the average number, right? But with volume weighted average price, what we're doing is we are weighting the average price based on the volume. And one of the things why we're doing that is because we want to know how serious those price changes are. You have a stock like GameStop or GameStock that may do some crazy things. So you may see in the after hours, you see some drastic price changes. It's like way up, it's way down, it's all over the place. One of the reasons why that happens, and one of the reasons why, if your system allows you to trade after hours, just you as an individual retail trader, you may get a little warning that's telling you like, hey, be careful. This is why. Thinly traded market, risky. You want volume, right? You want a lot of volume. You want a lot of people trading. From that volume comes stability, right? Because if you have a very thinly traded market, now whenever you enter a large order to buy something, you have a potential to impact the market. Imagine if no one's buying GameStop, right? No one's buying it. No one has any interest in buying GameStop. And then you enter an order for a certain whatever limit price you have. Probably not going to get filled because there's not a lot of demand. Nobody wants it, right? Nobody wants their GameStop, right? So you're probably not going to get executed. So what does that mean? You got to increase your limit price, right? You got to make your limit price more attractive to attract some buyers, right? So you're like, okay, I'm going to buy one share of GameStop at $200, but no one's buying, no one cares, right? So you're like, okay, $220. No one cares. Eventually, if you get the price high enough, obviously I'm creating a really, really crazy scenario to get the point across, really, really simplifying it, making it easy to understand. Eventually, you're going to get to a price. Everybody's got a price. I mean, just for example, I'll be really extreme. Let's say I'll buy one share of GameStop for $1 million. I guarantee you're going to get executed super fast. If you're paying $1 million for a share of GameStop, I guarantee you're going to get executed real quick. Now, that's an extreme example, but the point is, everybody has a price, right? So if you're trying to sell something, the higher the price is, the more aggressive you're getting, the more likely. So what happens is if there's not a lot of people buying, then that can create wild fluctuations in price because, again, not a lot of people there. Now, let's change that scenario. Let's say that now we have 1,000 people that are interested in GameStop. Different price points, but now we have a market, right? So now, instead of that, trying to get that one person who, all right, $1,000, I'll take $1,000 per share, right? Instead of waiting for that one guy, maybe there's someone else who's like, I'll take 900, right? But we have 1,000 people, so maybe there's someone who will take 800, maybe somebody will take 700, right? And let's increase the numbers. Let's say 10,000 people are interested in GameStop, so we have much more volume. Now we're getting down to someone probably $500, right? Then we start getting into hundreds of thousands or whatever. As the higher the volume gets, now things are getting more reasonable, right? So thinly traded market, you have a lot of high volatility that can potentially happen. That's why you have the fluctuations in price. Volume weighted average price helps to protect you from some of these risks, because if the price is fluctuating drastically, is this someone playing games trying to manipulate the market, or is this just a momentary thing because not a lot of volume? Like, what is the weight that I should put on this drastic price change, right? I want to see how many people are willing to pay this price, right? I want to see, just like I mentioned before in my VWAP video, I want to look on like Amazon, 5-star rating product, only 4 reviews. I don't really care. 4 people, 4 people means nothing. Every one of those people probably works for the company. But if I see 10,000 5-star ratings, I'm thinking, it could be fake ratings, but still, you get the point. Same thing with VWAP. With the VWAP algorithm, you are targeting the average price, but weighted by volume. So therefore, when the price fluctuates drastically during times of really low volume, you are not drawn into that sort of that little bit of a hole, right? Because you're going to average out based on volume. So you'll see a lot of time with the VWAP, you'll see a lot of fluctuations in the actual price, but the VWAP itself will be much smoother. The VWAP looks at, crazy price changes with low volume, and it's kind of like, I want to know where the volume's at. Where are a lot of people, where are the largest group of people, like where are they at in terms of what they're willing to buy or sell this stock for? So that's the VWAP. Now the TWAP is obviously time weighted average price. So we're looking at the average price again, but this time we are weighting by time, not by volume. So the reason why I would want to use a time-weighted average price targeting algorithm, because again, these are benchmarks, and you can use benchmarks in your algorithms. So I can build an algorithm that looks at this benchmark of time-weighted average price or volume-weighted average price and attempts to stay be better than that, or stay close to whatever your goal is, right? But use that as your metric, because it's like, what are you trying to do? What are you trying to achieve with this algorithm, right? I want to do better than VWAP, right? So if I am selling, I want to be above the VWAP, right? Because this is the average price it's trading for, right? I'm selling, I want to get the most for it. So if this is the average price and I'm selling for above average, I'm doing better than the VWAP. That's pretty good. I want to sell my stuff for higher than most people are, right? So that's the kind of way you look at it. Now, TWAP is, I've got 1 million shares of GameStop Anyway, GameStop shares that I want to trade. What's up, Nemo? Nemo is in the house. I've got 1 million shares of GameStop that I want to sell. If you put 1 million shares of GameStop on the market, you are a big dummy. Man, the market is gonna go crazy, right? Everyone's gonna see this large order. They're gonna know that you've got a ton of shares you're trying to get rid of, and they're gonna be like, really? So the price is just gonna go through the roof, right? Well, actually, the other way. If you're trying to sell, people know that you have all these shares you're trying to get rid of, so they're gonna be like, so you're trying to get rid of this stuff. Okay, they're gonna lower their prices, right? If you know someone has to sell a large amount of shares, then you can lower your price, because if they don't lower what they're asking for whatever they're trying to sell, then they're not going to get it sold. And clearly they need to get it sold. That's why they have it on the market, right? So basically that's going to push the prices down, because people can be like, all right, you got those shares, you got to get rid of the shares. All right, well, give me a discount. Give me a discount. How about $5 per share, right? So market impact. That is the problem that you're trying to address when you're dealing with a time-weighted average price benchmark, when you're targeting the time-weighted average price. So instead of sending out 1 million shares and really moving the market, what you do is, again, you're breaking your order up into little slices. Again, it's the idea of you have a TWAP algorithm that your trading platform uses. So you enter the order for 1 million shares of GameStop that you're trying to sell, right? And then the algorithm says, okay, TWAP, and you set like a start and end time. So maybe you have an idea that generally there's a lot of volume that happens around 3 p.m. or whatever it is, whatever your goal is. So I want to get executed between 2 p.m. and 4 p.m., right? So rather than just sell 1 million shares of GameStop, what it'll do is from the start time, let's say 3 p.m., it's going to put out, sell 500 shares GameStop, right? Sell 1,000 shares of GameStop. And it's going to slice it up over time, right? Still targeting the average price, but the average price is weighted by time, not by volume. So again, one of the things that you're looking to do is to minimize your market impact. You don't want to broadcast to the world that you have a large amount of shares that you're trying to buy or sell, because that can essentially move the market away from you and you can incur a lot of losses. So if you're trying to sell, that can make the prices tank, because people know that if you've got to get rid of it, then you've got to meet what we're willing to pay. Right? You can't be bossy. Right? You can't be a boss and be like, I want to sell 1 million shares of GameStop and I want $1,000 per share. You're the one with the shares that you're trying to get rid of, right? So you're going to pay us, the buyers. You're going to take what we, the buyers, are willing to give you, right? We're the one that's going to set the prices, right? Because you need to get rid of it. We don't need to buy it. Right? We don't need to buy what you're selling. You're the one that has the order out there, right? So we're going to say, I'm only willing to pay $20 per share. And that's that. You don't like it? Well, stay with your shares of GameStop, right? So that is kind of the idea behind the TWAP algorithm. Now, one of the issues there is because remember with the VWAP, we were looking at the volume. So we were kind of protecting ourselves from massive fluctuations in price that may happen during low volume periods, right? Or thinly traded stock, a stock that doesn't have a lot of volume. So there's a period of time in a day where maybe there's not a lot of volume and therefore volatility comes in. Not a lot of people that are in the market right now. So the prices can fluctuate drastically, but your algorithm is only looking at time, not looking at volume. So you can maybe get some bad situations happening in those periods of time. So there's some risk there. None of these things are perfect, right? You never know where the market's going to go, but these are just some strategies and tactics that you can use to achieve the goals that you're looking for in terms of trading. So we did what is a trading algorithm, why you use it, how you use it. We talked about things like setting aggression levels. We talked about how you do your performance analysis. How well is the algorithm performing? Your TCA, transaction cost analysis report. And there's theories behind that. You can Google online and learn about transaction cost analysis and the different theories about it. In reports, you'll see things like sort of indicators that give you an idea of what was happening at the time. So when you got executed, where you got executed in terms of price, comparison to benchmarks. So whatever particular benchmark that your algorithm is using as a baseline, you'll see this is where the benchmark was in terms of the price point. This is where your price point is, so you can assess whether you did better than the benchmark or less than the benchmark. You can get a sense of also your executions, where they fit in terms of your parameters, passive prices, aggressive prices, and things like that. So there's a lot of factors. I mean, pretty much anything that the algorithm is looking at or utilizing to do what it does, that stuff can be charted and reported on, so you can do a full analysis and look at graphically, these were the conditions, this is where we were at in terms of prices, and this is where the benchmark was that we were trying to beat or stay within, right? So we covered that, and then we did I guess the parameters, which I guess I just kind of covered again. So from a fixed protocol standpoint, obviously, and I guess let's talk a little bit about, really briefly before I end this live stream, about and I'm going to show you a quick algo before we end the live stream. If this is helpful to you guys, click on the like button. If you're new, subscribe, smash that bell, because no one gets notifications otherwise. And even if you do click the bell, you might not get notified. But anyway, so a little bit about the behind the scenes, right? Electronic trading platforms. So typically what you will see is you may have an EMS vendor, for example, execution management system, right? So this is a trading platform software. So an EMS provider who, their service is this trading platform or software you can use to manage your orders. And if they offer algorithms, then what will typically happen is that provider will basically certify. So it's not only, there's a lot of different angles here. You have the provider of that trading platform having their own algorithms, and you also have that provider providing access to other people's algorithms. So for example, you can have a company that has connections to different companies that have algorithms, and so basically that platform is certified to, as far as the fixed protocol, certified to be able to send algo orders to a particular destination, right? So let's say Credit Suisse, for example, they have their own algorithms. So if I have an EMS software and I have a relationship with Credit Suisse, so we have connectivity, we're certified, so our product is capable of sending algo orders to Credit Suisse. So anybody that uses our platform will therefore potentially have access to using their algos. So pretty much what happens is, you're gonna, in your system, when you're entering your order, you have destinations where you can send the order to. There might be some drop down or something that says, Credit Suisse algos or whatever company it is. And you're going to choose that. And then once you choose that, and you choose all your parameters, aggression levels, all that good stuff, then the order goes out. Those parameters are going to be in custom tags. So in fix, you have some tags that will be like, 3056 or some crazy number like that. And let's say this algo has something called aggression, and there's 9 levels of aggression, right? So tag 3560, just random tag, right? Tag 3560 equals 9, most aggressive. Tag 3560 equals 0, very, very passive, right? And that's all. So you click on your drop down, you choose aggression level 9. This fixed compliant application creates a fixed message that includes that custom tag that has the value of 0 through 9, whatever you chose, routes it out to the algo provider, right? They receive your order. They process the tags on that order. They see for example, the aggression level that you set it to 9.
with options. Your entire strategy is based on what you... I'm gonna give you the fixed protocol. Options Greeks.
Okay? Und das löse ich jetzt nach Beta auf. Okay? Das ist wow! Haben wir das auf Video? Geil!